conversion risk power forecasting. Probably some of you have joined the session before. That was about PPAs, so this is very similar. So of course, as many markets have implemented market-based incentive schemes for renewable energy projects, power price forecasting is crucial for developers, for investors, for owners, operators to assess market risk, to support investment decisions and to take mitigating action. So I'm very happy to introduce two panelists for this morning, this afternoon. First of all, Nicolas Lanoux de Menton. Nicolas, and then I will manage to pronounce your name well. Nicolas is commercial and BD manager at RES in France. So RES, of course, is a large developer and operator of renewable assets. Have a project portfolio of about 19 gigawatts. Globally operates about 7 gigawatts of assets. So very happy that you joined us from France, Nicolas. And our other speaker, panelist for today is Prejavad Gadfai. So he's a private equity manager at Actis in the UK. So he joins us from the investment world, leading investing growth markets in Africa, Asia, and Latin America. And of course, including the energy sector, over about 15 billion of assets under management. So this session is 30 minutes, and thereafter we open for Q&A. So with a total of 45. You can also stay on after this session, because then we will have a Meet the Expert session of about 30 minutes, where you can ask, other questions on PPAs and power price forecasting to our experts. Excellent. So, many thanks again, Nicolas and Prejavad for joining. I start with the investor. So, and that's a question for Prejavad. As an investor, what are the key main difference, in how you assess finance for wind projects exposed to market-based incentives and power prices in comparison to wind projects with guaranteed revenues from feed-in tariffs?
Yeah. First of all, hi everyone, and thanks, Bot, for that amazing introduction. As you can imagine, the markets that we invest in Actis is quite a vibrant space and a diverse set of countries, right? So as private equity investors, we are present into Asia, Africa, and Latin America. And each of these continents, and within that continent, each of the markets are at different maturity curves, right? So in terms of how they have the market accessibility, merchant market, whether there's present or not. In some markets, it's there. Some markets it's nascent, some market does not exist. But to answer your question, the places where this market exists, so some of the Latin American markets, basically where this is a growing space, and some of our other markets, the way we look at finance for these assets is mainly dependent on the appetite of the lenders, right? So different lending space. So we work with a vibrant, again, a diverse set of lenders, DFIs, commercial banks, and other institutions. So they have particular requirements around financing of if you have a 20-25 year PPA, which is very typical in the markets that we work. We have a long-term, 70 to 20 year project finance with a very good sort of benchmark rates, right? When it comes to obviously PPAs that are either CNI, that we do a lot in Latin America nowadays, and it's an evolving growth space for us. The PPA term is, let's say 13, 15 years. You would be looking at, a similar length of the project finance. Obviously there are 2 or 3 key factors which change when you go from, a typical feed-in tariff project finance versus a PPA, which is merchant-based, and it could not be, it will not be 100% merchant. You can have a lot of layering, as you know, Bart. You can have a CNI PPA, which accommodates 80-90% of your generation, and you just have then 10% exposure to the merchant market. You could have a little bit more exposure depending on the different projects. But basically, I think what the lenders are taking a view in these markets is what happens to the spot market exposure for these projects post the PPA, the CNI PPA, right? And that assumption depends on different markets. So I'll basically take an example of Brazil. In Brazil, it's not uniform. You have 4 different subsectors or subsets in Brazil, and each of that subset, depending on the region, projects its own merchant tariff for the next 20-25 years. Now, we all know it's extremely difficult to forecast that. And so banks, depending on where the project is located, would take a view about the merchant spot market tariff that they would apply to the energy post a CNI PPA. And now, most of the cases in our markets is that we would get an extension of the CNI PPAs because we are at a discount to to what the commercial heavy tariffs are. So we obviously have refinancing, but I would say the term, which as I mentioned, it becomes shorter as you have a shorter life of PPA. The spot market exposure and the assumptions that the banks can take. And also, what do you assume in terms of your P90? Do you get 1-year P90, 20-year P90? Depends on the lenders and their appetite. In most of our markets, we are one of the leading IPPs through our platform companies investing into this space. So, we are the first ones potentially in most of our markets doing this, right? So we are kind of, as we go along, setting the precedent, but, things will evolve in our markets and become more mature.
Excellent. Yeah, thanks a lot, Frederick. So actually, it seems that you already have a lot of different instruments at hand, right, to manage, your finance, aspects, let's call it that way, for wind. To Nicola, how does it look as a developer? So, if you see a market changing from a, let's say, guaranteed system into a market-based system, what are the, and I would say, opportunities for a developer to be looking at?
Yeah, so first of all, hi everyone, and thanks again, Bart, for the invitation today. So first of all, as a developer, just worth mentioning that RES is not an IPP, so we're a pure developer. So we have to find exit for our projects in the different market when we operate. And so we are not present in Latin America, but we are present in North America, Canada, Nordics, Australia, and France, of course, and UK and I, basically. So if I take that from the investing side on what you've said, so the fact is that we see more and more appetite from the investors, and in particular pure equity investor for pure merchant projects. So basically, we are not so much concerned about the lender aspects. So even though effectively corporate PPAs, so I would say 20 years corporate PPAs is the holy grail for lender, but in some markets like the Nordics, for instance, we see investors willing to enter that market on a full equity basis and to take merchant risks. So that means capturing theoretically higher rates and higher return, but of course being more exposed to the power prices. So on top of that, there's more and more demand from CNI corporates, and so we see that market is shifting now. So that was a buyer market, but we see that market is changing, and that hopefully that should become a seller market because of the scarcity of the project. So the demand exceed the offer, so which is good news for us as a developer. And on the developer side, yes, definitely there's some opportunities. So there's a change in the way you're developing project, because before what matters was the capacity you were installing. So what mattered was the number of megawatt, and this kind of thing. So now what matters is how you maximize the energy of your project. So that means the location of the project is now key. So in particular in the context of the cannibalization effect of the prices. So we see more and more, and we try to have more and more sophisticated models to assess exactly what is the capture prices on some key locations. So we see, for instance, in North America, some zones like the ERCOT, like in Texas, you've got a lot of wind projects. So of course you could say, okay, there's a cannibalization risk in this kind of zone. So that's why as a developer we have to we have to be more sophisticated on this and to find the right zones where to develop the projects. So that's the key element today.
No,
as
excellent,
from the
Nicolas.
developer point of view.
It seems that actually it's great to be a developer these days. So what you were saying actually on the finance, you see actually opportunities, right? Even under merchant risk environment, and as well as like you talked about the C&I clients. So there's a pool on projects. So that's very positive. So Pretivar, so now let's go talk a bit about power price forecasting. So how do you use power price forecast for your investment valuations and particularly the decision-making processes? And then of course internally in your organization, but also with your partners. How does that work?
Sure. So obviously, power price forecast forms an anchor data point for us. So when we are going into our markets, or at least in our markets, as Nicolas mentioned, probably in the mature developed markets, it's the exposure to merchant tariff is extremely high. As Nicolas mentioned, it could be 100% of the project. In our case, we try to de-risk that element by bilateral contracts. That bilateral contract could be with a C&I customer, or it could be an auction PPA if we have one. That then we will have a very little exposure to the merchant, right? But wherever there is an exposure, the way we go about is at least 3 data points, right? So there is the power price forecasting, which with a lot of modeling, Monte Carlo simulations, stochastic analysis, scenario analysis, you're trying to predict the world. And while doing so, you're predicting how the policies, regulation, technologies, cost, scale, all of that comes into play. And so we obviously select the best consultants that are there in the market. But as we all know about, that analysis can only go that far. So as you see that power price forecasting, I think it's very accurate. It's become more and more accurate for the first, let us say, 5 years, right? But as you then go in the future, it becomes extremely difficult to predict. And so that's where what we use as a second benchmark, which is we in the industry are present on the ground, right? Actors has boots on the ground in terms of we have 13 offices across the globe in our markets, and then we have our extended teams, which are our management teams, which are also in those markets. So we keep a very close tab on the calculation of what the customers would be willing to pay, and how the evolution of different things are happening into the market. So what are the other competition products? So let us say a pure price merchant would give you a price of, let us call 200, right? We would then go and want to understand to some of Nicolas' points about cannibalizers, competition, congestion in that area, demand, special incentives by the government, focus on the region, state, or if it is a particular region. So we would focus on that, and that gives us another lever to think about whether that power price forecasting that we are making is correct, right? So we do not take just the value that comes in the report and apply it. And the third thing which we think about is the overall risk, right? So is the exposure to merchant price 10%, 20%? It's usually around that still in our market. I think we are quite lucky as compared to the developed markets where the risk is quite high against a merchant tariff. We are still in the space as emerging market investors where we enjoy, again, 13 to 15 year PPAs on the C&I side and 20, 25 years PPAs on the feed-in tariff. So that's an excellent space to be. So that reduces our risk fundamentally. And the third portion is that basically how much of your exposure is there. So if your exposure is more, you would think about very long term the implications of this, and also project financing. We do not go for investment as private equity investors. We use financial engineering as to boost our returns. So we would take all these three and find the sweet spot for us, the right long-term view for what it would be the merchant spot exposure. Obviously, as the merchant spot exposure increases, so should your risk adjusted returns, and we are very focused on that as well, on how we travel that path.
So it seems that there's no standard answer, right, to this straightforward question. That you have,
unfortunately not.
Exactly, lots of different instruments and techniques. Of course, you need to understand them well, and power price forecasting is just one element in the investment decision process, and there's various ways of mitigating it. Yes, no, of course, very well explained, Nicola. Then on your side, so how would you value PPA contracts? How important are power price forecasts for you to assess, let's say, the value of the projects you're after, and then particularly also in relationship to PPA pricing?
Yeah, so first of all, as Priyavart was mentioning, the market is becoming more and more aware of these aspects. And I remember that 10 years ago, during the closing process, I mean, we were just putting some figures in the model, and that's it. And no one was really understand what what happened. So really, that's a major change. So we see, yes, more and more, top consultants providing curves. But of course, as a developer, yes, you have to have your own views on this. So we're using, of course, the curves provided by the market. So and then we do some blended calculation. We take the curves, and then we have to apply some different factors to take into account specificities of the project. So there's two different type of time horizon. So first of all, so you've got so I would say between 5 and 7 years. So normally here you've got visibilities provided by the market. So if I take the Nordics, for instance, you've got the Nord Pool market with a liquidity until at least 5 years. So so that means you can put in place hedges on this horizon very easily, because the market is very liquid. So that eases the process definitely in this kind of market. So that's not too difficult within that time horizon. So after that, so I would say that's a bit crystal ball, because of course the electricity remains a commodity. So by definition, I would say by essence, a commodity price is not predictable. But of course, you get global trends, and that's why, I mean, yes, we are buying the market prices, and then you've got to add intelligence on top of this, because we know some jurisdictions. So that's very different in France, in the Nordics, in UK and in the US, of course. So the market is different. In Europe, that's mainly driven by the CO2 prices, for instance, the gas prices. So that's the different things you've got to take into account. And that depends also on where you're exposed, because normally you've got, I would say, 10, 15 years PPAs in place. So that means you're exposed after that time horizon. So and so of course that impacts or not some of your projects. And so that the different things we use to assess the PPA's prices. But that's worth mentioning also that the PPA prices from a developer point of view is driven by the project LCOE. So of course, so that gives the market prices, so that gives the market target, and then from the developer point of view, we get to say, okay, for that specific project, our LCOE is X per euro per or dollar per megawatt hour. So, and that's the balance between these two prices.
No, fully understood. And what I liked about what you were saying somewhere in the beginning, that in the Nordics you see more opportunities to also hedge it, and so we will get back to that a bit later. So I like this very much. I'd like to drill a little bit further into the depths of power price forecasting. So Priyavart, so what are the key elements of a power price forecast you would value most? I mean, you have things like transparency, right? Transparency of the inputs, like what Nicola was saying, CO2 prices, gas prices. transparency in relationship to the outcomes. You have a robustness. You can have sensitivities. What makes a power price forecast bankable? And that is a word, right? But effectively, what are the elements of a power price forecast you would want to see as an investor to make it bankable?
Yeah, great question. So what does a bankable power price forecast look like? I think as we go in the world of uncertainty and volatility, I think first of all we select the best, such as yourself, Bart, in terms of going ahead with such power price forecasting. Somebody who knows the industry and has to be really able to convince us that having our own experience of investing in these markets, and for the past 50, 60 years, we do have our in-house views as well. But
Yep.
The most important thing for us is the objectivity the consultant can bring, the independency they can bring, and highlight the trends that basically would be there beyond the 5-year mark, right? As I said, the immediate short-term forecasting, I would say most of the consultants get right.
Yep.
I think what differentiates the bankable consultants is who can evaluate and synthesize and then provide outputs on the period of you're trying to forecast for the next 30 years. So a significant amount of time. Now, as investors, we are quite we, as I mentioned, we know the constraints of power price forecasting. We have been there, we have seen it, whether it's in mature markets or developing markets. So there are certain constraints, and I think as far as you understand the constraints and the difficulty of that job, you start appreciating what you're asking somebody else to do. So what we do not do is pass on the risk for somebody to prepare a report and put it on our desk and take the view. So that is not something as investors that at least we do. What we do is get very involved in the process, about estimates and how trends are growing, which trends would take over, whether it's energy transition. Now we're talking about hydrogen, how thermal players will move or shift and use hydrogen or their assets, which assets form the major part of renewables. Now we know that solar is just going to go much more on a accelerated growth path as compared to wind, right? But 2-3 years back, when we were also doing power price forecasting, I think we had the same view that solar is really on a very sharp learning curve, and you're trying to predict that learning curve for offshore wind, onshore wind, floating solar, other kind of hydrogen, battery storage. So it's really about an overall holistic analysis, understanding the limitations of the power price forecasting. I would say to a certain extent, not completely only relying on power price forecasting, but discussing with experts on the ground, understanding how the market structure is. So, but give you an example, think about Brazil, right? Brazil is extremely dependent on hydro. If the reservoir capacities and the rain forecast at a certain extent, then the power price forecasting goes up or down. How do you get it right? Rain is uncertain. So it is a job of a very good consultant to synthesize that. And it is a job of us as investors to probe and discuss each and every point and find counters to our own points, not to believe in single truth, and have plenty of scenarios, as you said. And I think that's how you sort of would triangulate that price which you want to put in a bankable form for your investors as well as for developing the project.
So actually, what you're saying, Peter, is actually you actually prefer to see, let's say, different curves, right? So that gives you an understanding of what the fundamentals are driving the power prices, so that ultimately you can triangulate to an outcome, so to a power price curve you can use for the investment decision making process. That's what I'm hearing, and it's really a dialogue with the advisors you are working with, and then of course with the analysts you have in-house.
That's right.
Similar work. Yeah.
But I think I would just add one more thing, right? I think we also got to understand, at least in the world of project finance, about what the banks are willing to underwrite, because you can have your own view about the world. And if the banks have a very different view, then you have to take that into account for at least your project financing, your debt structuring, right? About how much equity you would need to put in play. So, to answer your question about how we take this forward to our IC, is that we have a very clear view. We have pre-discussions with banks. We know what the banks are underwriting. Different banks again have different standards. Again, being in that space and having done over 200 projects gives us a very good strength across our markets to know where the banks are moving, where would they, are they mature, are they going in that direction of risk appetite, and then we kind of come to that place where we think this is the right power price.
Excellent. Yeah, so now I'm checking time. I think we're still good, but we are like 5 minutes to go before taking some of the questions from the Q&A. Short-term price forecasting. Now, of course, Nicola, as an operator of wind projects, you know very well that you have volatility in the generation of the projects you have, and particularly short-term. So, of course, things like intraday price forecasting can become more relevant. So, how much do you already make use of short-term price forecasting? So that's really, to get more value out of the operation of your assets.
Yes, I mean, for the timing, we're not so much exposed to short-term prices because that's, I mean, we as a developer, we are not trading electricity. So basically, of course, what we try to do is to optimize, and in particular for assets that have exited subsidies, like in France, for instance, there's a global market for that, because this project will be repowered after. So there's a period, so we have to bridge the gap between after the former fit to the new schemes that will be put in place. But basically, yes, we use forward prices basically. So we hedge on forward curves, so on an annual, quarterly, or quarterly basis. But we are not so much exposed to short-term prices. So that will be the next step. And just to come back to what has been said, and yes, definitely that we have the same view, and we think that's a dialogue between the different players. So we are not taking the market prices as granted, but we are discussing. We are trying to challenge what is said, and to try to really understand what's the rationale for these prices. And of course, some consultants, for instance, they take very pessimistic approach on cannibalization, but we think that the market will react to that. And for instance, in some project, we'll use co-locations with batteries, and we'll use hydrogens. And so we are not sharing that pessimistic views, and we think that because the LCOEs will be driven, will decrease, and especially in storage, cannibalization will be mitigated.
Okay, but that means that so far for short-term price forecasting or your short-term price risk is something you typically are less exposed to. So you also you're not so actively looking at short-term price forecasting like intraday prices, although potentially, presumably that might change. You talk a bit about quarterly or seasonal, and it might also be that for your maintenance planning, you also might need to have some shorter-term forecast for your prices, and you can probably optimize your maintenance scheduling, I guess, right?
Yeah, absolutely. I think if I can just add, Bart, I think you're right. So, not so much exposure for at least us on our portfolios, but our platform companies do keep a very close eye on that, excess generation in periods of good wind or good solar productions, and we do try to get into those very short-term gains. And I have to say that it has been extremely profitable But as I said, that's not our base business case, right? It's the cherry on the top you get when the markets are,
exactly.
And both the resources and the markets are going in that direction, and certainly take the advantage of that. But yeah, that's something that we keep a very close pulse on.
Okay, excellent. Thanks a lot, Predavar, for that. So I do not see any questions yet in our chat box. So I'm being told that we can continue. We still have about 50 minutes to go. Of course, more questions. We talked a bit about, or Nicola talked a bit about the hedging, but I like to ask that question to Predavar. So if we talk about emerging markets, then typically we talk about it from a renewable energy development standpoint. However, as a power market expert, when we as a power market expert talk about emerging market, then we typically talk about mature markets, mature power markets, where you can trade and hedge and so forth easily, and less mature markets. So as you are, quite active in emerging power markets, so what do you see as let's say the challenges or opportunities, of being active in less mature power markets, where you probably have less opportunities to hedge, less transparency to trade contracts and so forth. So what would you see as the major differences between a mature power market and an emerging power market as an investor?
Yeah, it's a good question. So on the less mature markets, the trend about has been not to have these merchant markets or exposures, right? And the opportunity is plenty, right? I mean, when you think about the markets that we invest into, about the world's more than 80% of the population is in our markets, right? So we are talking about Asia, Africa, and Latin America, and Asia is massive. A lot of electrification still needed, a lot of people still to be connected to the grid for the first time. So a lot of these less mature markets are actually still in the feed-in tariff regime, still in the long-term 20-25 year. I mean, for example, in India, we get a 25-year PPA. India has an auction every, if you're lucky, you get 2 in a month, and you just have a run rate because the kind of development that the government is envisaging needs that kind of a push and auctions. So you're looking at thousands of megawatts getting auctioned every quarter. Now, in that opportunity, you do not have any merchant risk at all, right? As I mentioned, and then you go to the other side of the world, and I would say Africa is securely a long-term PPA structure in South Africa, Kenya. But when we go to the West, Latin America, it's opening up. It's one of those, as you mentioned, mature emerging markets, right? And I would say still the hedging products there is no hedging product as such on your fundamental risk of power price. There are few, or if there are, then they are price prohibitive. So you are in the space of discovering that product, right? And I think the trading agencies and the developers, and as well as the IPPs, all of them are trying to find the best risk point for each of them, and who has and in our view, and at least in my view, the risk should sit with the people that are best able to manage it, right? So whether it's a developer, investor, the operators, right? So
so you would be looking for partners potentially, right? Who would be probably better able to deal with, let's say, that less mature power market risk, if possible.
So for example, trading agencies, right? So we are not into trading. Trading is not our business, but we do contract with trading agencies, which take that intraday, inter-season, inter-month risk, and that is fine. That is that's a different kind of business. So we very much stay close to our focus. Focus and this basically the intensity of an investment comes through a very clear and a focused strategy of what we are and what we invest into. We don't try to do everything in the world because everything comes at a risk, and as I mentioned, risk adjusted return is what we go for. So we partner then with trading agencies which are doing that business and which are taking that risk. And I would say fundamentally much more better to take that sort of intraday risk rather than us trying to forecast prices for a country. And so that's a partnership that we go for and evaluate. But again, very little of our energy actually goes into that space. Fundamental, I would say, we are still looking at long-term PPAs, at least in context of mature markets, 15-year PPAs, 13-year PPAs, even on the CNI side, it's long-term.
Excellent. And let me check if, thanks for that, Prithivar. Let me check if there are some questions, which I can address here. And there are a few in our box. Yeah, this is a good question. Also in relation to the last point we wanted to discuss in this session, the role of government. So let's get back to that last point at the end of the call. So there's here a question concerning the markets and the need for actions to mitigate climate change. Do you think that auctions are a solution, or are there other mechanisms? And you should be able to see the question. So considering the markets and the need for actions to mitigate climate change, do you think that auctions are a solution, or are there other mechanisms? So, and I guess that relates to, can auctions help to keep moving faster, right? In terms of...
That's right. So if I can take a stab at it, but I would just mention, auctions are really great for investors as well as other stakeholders who are wanting to enter in these markets, especially because the government gets to find the best price. First of all, so they're competitive auctions. You definitely find the best price if they are competitive auctions. And the other benefit of doing auctions is you accelerate. You're not asking people to invest first and then decide their returns, and you are fundamentally auctioning out capacity in a very structured fashion to the places and locations that you want to, identifying the supply-demand imbalance. Central governments or central agencies doing auctions is definitely very helpful, because they can be much more structured than all of us just put together, because they have the view of the overall system. And you do not want just a fundamental concentration of renewable resources in one state or one province, because then how do you ensure that the development is much more diverse? And then, as you know, Bart, in today's world, apart from just being an investor, we are very sustainably focused investor. And so, how do we ensure that there is sustainability in our investments, there is diversity, and that that impact of our investment goes to the wider community. So, having that auctions definitely helps.
Right, you're very positive. Nicola, you also addressed auctions a little bit, and I think you talked also about siting, right? So finding the best sites, probably with lowest LCOE. So how do you, as a developer, look at auctions? Yeah.
Yes, the auctions is about, the role of governments, and that depends of the targets of each countries. And we see that, that will be very difficult to achieve, and especially in Europe, the UE targets without any subsidies or kind of support schemes to foster the energy transition. So, of course, CFD is of importance. And in France, for instance, most of the projects are still under subsidies through a CFD mechanism. So we see that in the UK in the UK, you've still got some ROC support also, and so that helps also to preserve project finance in the project, because as we said, without any CFDs or support mechanism in place, that's difficult to attract lenders and financiers. So with the exception of pure equity investors, but you've got alternatives to auctions. You've got, for instance, in Spain recently, they've added a support mechanism in the form of guarantees for energy-intensive company. So I understand that that will work as a backup guarantee for and for PPA. So you've got alternative options, but yes, of course, CFDs. Yes, that's the main option.
Yeah, no, excellent. And there's various other questions in the Q&A, but I'd like to keep focus a bit on the topic of governments. And now, as the topic, of course, and as what we are very concerned about is that we have to keep moving faster. And of course, if we are looking at in a way increasing merchant risk, and with the topic of power price forecasting, So I like to finalize this session, and thanks a lot again for your participation with your view on what governments can do in a merchant world, right? So where governments are pulling out their, let's say, guaranteed revenues, so opening up markets to allow for more merchant risk. What can governments then do to make that happen and work, so that we have even more project development and financing in the wind industry?
The first point I would say is that that's the government and the policy certainty on a long-term basis, and I guess yes, that's very important for us as a developer, but I guess that's even more important for financiers and investors. So that means yes, you've got a certainty that there's a stable policy, that you won't see, retroactive cuts or these kind of things on the schemes already in place. And so we've talked about yes, the CFDs or alternative mechanism to be provided, and that's more yes from the developer point of view, but that's incentive to and procedures to develop and to ease, for instance, the development process. So we see in particular in France, but in UK and I, that's still very difficult to develop. That takes very long. So in France, that could take up to 6-7 years to develop a wind farm, because of the permitting process that is very heavy, because of the grid constraints, and we see the same things in the UK. So yes, that's a key point, of course, and to foster and to boost the energy transitions, and so that's the main point.
Yeah, what's your view, Prejavar? I also got a question on particularly on Brazil, and how to best introduce risk in the Brazilian market, right? And so probably related to question of what can governments do, to keep moving faster. What can they particularly do in the emerging markets like you're active in, and Brazil specifically because of the question we got in our Q&A?
Sure. The governments, going back 10 years, maybe the governments needed to do more. Now we are at a stage, Bart, where the renewable energy LCOE, whether it's wind and solar, has definitely gone down lower. And I'm thinking of how many thermal auctions have been there in the recent past. So none is the answer. I can't at least recollect one. So the focus, and I think the acceleration that renewables is on a great move, right? It's a growth story. It will fundamentally transform and transition our energy system across the globe. How quickly or how efficiently we reach there is one of the things where the government can really play an enabler, right? So, and the government in our markets does play an enabler. For example, to your point, Nicholas, about it does become difficult to acquire land, and so places like India, you have ultra mega parks. You have one single park where the land is provided and the interconnection is provided by the government, and it would be 1.5 gigawatt, right? And that the government is then basically shortening the development cycle and not wanting people to take 7 years to develop that projects, and so quickly going directly, giving you a particular area where you can interconnect that land, and then basically asking you to bid the best price for that, and which is great, because ultimately whatever that LCOE curve that we are driving, it is for the community and it is for the society to get the most reliable and the lowest cost of power, right? And then more and more people can use power, and more people can access it. So that's ultimately the service, right, that we want to provide. So Yeah, government as an enabler absolutely still plays a fundamental role, like everything else. Long-term policy, clear policies about investments. I would say, government needs to identify, and I think it identifies the new spaces of technology as they open up, whether that's battery storage or hydrogen, and come up with policies, procedures, and do you treat batteries as a generation source or a storage source, and we are continuously in dialogue with the governments to assist, in whichever way possible, that discussion. But ultimately, it is up to the governments to decide which path they want to ultimately take. So yeah, government do play a great role, but I think the motion and the direction are both correct. So they are doing certain things right.
But I think you're both very positive. I mean, it was a very positive session. I heard a lot of positiveness on the finance. I heard a lot of positiveness with regard to the PPA pool on your projects, like from CNI customers. I see that you are very positive.
I can just add one thing, Bart, and probably that the reason for our positivity, and this is not rogue positivity, right? So if you think about last year during COVID, which was the one, or two or three sectors which were considered essential service, and power, electricity was one of them. We could not have had hospitals running, emergency wards running without you having a secure, reliable source of electricity. So what has shown us during the last year is that one, the business that we invest into is extremely important. It's an essential service, similar to health. And second is that it is just going to continue growing from strength to strength because there are so much growth potential. So that's the reason for our positivity here.
No, excellent, and really appreciate.
And from the developer, just a few words. And we are also very positive because we've seen that following the COVID-19 crisis. I mean, there's a confirmed appetite from green assets. So clearly, that's very good news. And also that the story is not written yet on the prices and on the renewable. So yes, we've talked about power prices trend. So that's not written yet. That's not frozen. So, and once again, yes, we'll see new technology, hydrogen, storage, etc. So there's a lot of challenges, and so we are very positive about the future in the short, medium, and long term.
Excellent. Thank you very much. And we are overdue. I have a clock here. It says we are 3 minutes overdue. So I guess we need to close this session. Thanks again, Preservar and Nicola, for joining us. And we have a Meet the Expert session after this session where Carlos Albera and Martijn Maandag will also join us from DNVGL. So please join that session. And my understanding is we have to close this session and go to that session. And of course, Preservar and Nicola, you're also glad to join. They are happy to. But many thanks again. And enjoy the rest of your day. And the rest of our conference. Thanks a lot. Bye-bye.
Thank you. Thank you for.
Thank you, Bob. Have a good day, all.
What types of price scenarios do you consider? Any regulation-based ones or only commodity-based ones? I'll let you answer that one.
I think for this one, it's good to have to have also Bart in there. Typically, if you look at really a power price forecast, it's mainly driven on a market base, and the energy sector, of course, is also quietly dominated by the government and by regulations. So one and the other are always connected. But in essence, and that depends per market, but definitely when you look into Europe, it's really on a supply and demand base, combining those, and also with foreseeing trends which are upcoming. Normally, it's really that the supply is and that's due to the generation capacity that is available. So where the marginal costs are. So for example, that a lot of gas-fired power plants or coal-fired power plants are in there, so they will set the price in January. That might change due to the upcoming renewable energy coming in. And after that, also when hydrogen is coming in, that also might be some demand, which will be in the and then dominating the prices, or actually the prices in there.
So thank you very much, Martin. I would say that in the case that we see any kind of scenarios in which we go deeper, we can also have any kind of sensitivity saying, let's have, for instance, a regulation that will decommission nuclear power plants earlier than expected, or coal power plants like it's happened in Europe. That's something that we can tailor in each of the scenarios that we might look at. So we can easily play with any kind of commodity or regulatory based scenario.
Yes.
Thanks for joining. We started to address the questions without you. So
no worries, guys. I think I shouldn't. I should not have dropped from that.
No problem.
Session, but I'm back.
I'm raising the question so either Martin or yourself can answer
Excellent.
them. There's a question on very long-term forecasts, like 2050, where revenues forecast after 20 years contract for difference of a project with feeding FID in 2025. Does it make sense at all to try to build such a forecast, or should we accept that the prices might equally be €1 per megawatt hour or less than 100 euros per megawatt hour? So a tricky question.
Do you want to address it, Martijn, or shall I address this question?
I will leave this one to you.
Very good. Well, you always want to do power price forecasting, right? Whether that's for 25 years or 50 years, it's all about, at the point in time you need to make a decision. You need to have as much as possible, best information on your desk in order to support that. And so, although it might sound, strange to do power prices for after 25 years, it's very relevant to do so. What I heard in the question Carlos was raising, that power price might be €1 or so. Well, of course, we have seen, and probably a few years ago, that the market felt that because of the deployment of renewables in many markets, power prices would go down to very low levels. Actually, what we are seeing is that many markets still, would need to have dispatchable plant. Also, if you enlarge markets with more cross-border interconnection and so forth, you're really seeing that although volatility goes up, you still can get power prices which are not close to zero on an annual basis, but definitely are much higher than that. So it's very important to at any time do power price forecasting, and as we also talked about it in the session, use it to the best benefit of the decision-making process. And it's all about having information on the table at the time you're making the decision, and then also defining strategies to mitigate risk. Having said, of course, for wind projects after 25 years, with certain discount factors, of course, power prices after 25 years start to have a much less significant impact on your economics. But yes, you have to definitely do that.
And maybe to add on that, what is also important to make those kind of foresight and long-term views is also to get some feeling on what the high uncertainties are and what is impacting it the most. So which sensitivity isn't there most impacting, and whether or not you can have on the biggest sensitivity have a better view or a better understanding, or you're quite comfortable with, that says something in your decision-making process.
Yeah, of course. It's also the case that that you need to have a view on the market in 30 or 40 years to think backwards how that market needs to change in the next 10 or 20 years in order to get there in the next 30, 40 years. So it is a bit of an iterative process, and it needs to be consistent.
Yeah, I think that some clients of ours ask us to look into it's not so much about power price forecasting in those long-term scenarios. It's more a lot like, let's look into the mirror ball and let's see what we think that the market may evolve to and how the regulatory environment may evolve to in that sense. Do a very detailed modeling. And there are clients that come to us to asking for that, and we are able to provide that assessment in terms of futuristic view, let's say, rather than perhaps a detailed calculation.
Yeah.
Then there's a question that is saying, do you use different locations and types of PPAs to mitigate your market risk actively? I think that this was intended for the panelists. Is this part of your operating strategies? I may answer that based on my experience working with renewable power developers, and I would say yes, they work on that. They try to be putting not the apples into the same basket, trying to diversify the risk, and even within the same country, diversifying the risk might be investing in different technologies. So it's not just the PPAs themselves on different sorts or different plants, but also different technologies, different kind of client or different merchant environments. So yes, you try to diversify risks as much as possible. Do you think that accurate renewable energy power forecasting will benefit power price forecasting? It's a tricky question. I repeat it again. Do you think that accurate renewable energy power forecasting will benefit power price forecasting? And I think that's for either any of you.
Maybe I can start.
I can have a go if you don't.
No, I can try. I would say yes, because the forecasting of what a renewable power plant will generate, that is an uncertainty, and that's one of the uncertainty, which is one of the input parameters. So from the moment you can decrease the uncertainty of one of the input parameters, that will help. However, for power price forecasting, where you look at the bidding zones, which might be quite big, you might debate the decrease, and it also depends on where you want to use it for. You might debate how the extra certainty that you will get will help you. But it's definitely important how and when you want to use it. So for a long-term part, for a fundamental part, it might be of less relevance. But if you do it for the short term and potentially for your trading part, of course, the benefits in there will highly increase to have that.
Yeah.
Okay. And I think that was the question, because the question below was intended to RES, but we might sort this one out. How would you resource a market analysis section in RES? I think that the RES person, Nicolas, was mentioning that they were not an IPP, so they were not trading effectively with energy, but inevitably, to me, they are part of the market, so they need to be aware of the PPA schemes in order to have a way of or PPA or merchant schemes in order to handle those projects towards the consumer and to know the value of those projects. So to either of you, how would you structure a market analysis section?
Yeah, so let me take a first step at this. So what Nicola was saying was that that they would probably source out a lot of those elements, right? And that they have partners. And I think that Prejevar also mentioned that in emerging markets, there might be others who are better at analyzing, understanding market risk and taking that and so forth. So of course, so I. I mean, I think that we are. It's a bit dangerous. I mean, I think that it's a very positive market environment right now, right? Where probably you're not so concerned, and there are a lot of good projects out there, and that's what I'm sensing definitely from the session we had. At the same time, if your assets are getting more squeezed, if they become distressed, it's extremely important to as a generator. Understand the fundamentals of the market you are in, and the market exposure you have with the contracts and the ability to mitigate if something goes wrong, exit strategies, those kind of things. So ultimately, if you have so much value or assets, with value in a certain market, you will need to have. I mean, these market analysis teams will pay off, and you should not, well, you have to have the right balance with regard to having them in-house, versus the ability to well negotiate, talk with your partners. And the more distressed you become, the more competitive a market becomes. Typically, your market analysis team is going to be a bit larger.
Okay, I think that the final question that I find in the chat box is the same as we had in the PPA panel. Is, do you think that market prices will continue to decrease in the near future due to availability of large installed offshore power plants? So I think that the question could be summarized as, do we see that the power prices will keep on going down or up?
Yeah, I think the actual answer will be it depends on which market. But in general, what we foresee is indeed a downward trend. But there also the cannibalization pops in. But then, yeah, it's in terms of the revenue side and how much learning curves are there. So in the LCV cost, does it pay off? That are always big questions. On the other hand, which I touched upon in the beginning, if you're really going to look into more long term and changing about the market, and with all the hydrogen projects coming in, so using, so to say, the free electricity, or basically the electricity when the prices are negative, which we can see in various countries, when you've got something to use that and potentially to store that might be a fundamental change of the market. If you take a specific example of hydrogen, if you've built it, you will not only use it to make hydrogen when the prices are negative. At some prices, it even will also be feasible to operate the electrolyzer. And if there are substantial amounts of those electrolyzers in the market, it will then also kick in the market, and then it might even be changing from a generating-driven market to mainly a demand-driven market. To have some long-term forecast on that.
Yeah, I would agree that by the end of the day, the power market design is not a goal in itself, right? It's a way to achieve certain goals for businesses, for governments. One aspect, for instance, is that if the energy-only revenues are going down and the projects are getting less feasible, typically other revenues can come into play. And for instance, solar with batteries, they can have quite some value to system operators, right? So what you would expect is that system operators might incentivize the investment in solar and batteries. So that means that other revenue streams will come into play other than only energy only. And so it's very important then also not only to look at the market design as from an energy only standpoint, but also at different revenue streams, including also the support renewable energy can provide to a reliable operation of the entire system. And if revenues are going down and certain goals are not going to be met, then changes can be made to market design. Of course, to predict these is very difficult. Therefore, it's very relevant to have a good understanding of the goals of governments, of system operators, and so forth. So we do see prices become more volatile. At the same time, to Martijn's point, the market will use more flexible opportunities to manage that power price volatility, and but for some markets where you would, for instance, very high shares of renewable energy, particularly solar, you could expect other revenue streams to come into play at a certain point in time. And of course, we can help to understand what they have to be and what they can be, and of course helping system operators as well to understand what the best market design for their system services can be.
Okay, so those were all the questions that we had. So thank you both for your availability, and looking forward for the next sessions of the day. Thank you very much.
Thanks a lot.
Thanks a lot.
It was our pleasure.